Getting an inheritance can be complex and confusing sometimes. So we're here to give you 5 tips on how to handle it.
Hi, welcome to T-Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
And like how we mentioned in the beginning of this video, we're going to be talking about 5 tips for when you receive an inheritance or just overall how inheritances work.
All right, so probably the biggest one, Jay, that we deal with as advisors is explaining and going over the tax situation, because taxes are very complex with inheritances. All different types of assets that you may inherit are taxed differently. So maybe let's start there, because that's a big one.
Yeah, the biggest question I'll get is for a client, they got an inheritance and it could comprise of a lot of different things, and they think that everything is taxable, kind of
Right.
like an estate tax, but on the person receiving all of that. And so that's a yes and no. I tell them it just depends on what you all have. So the bottom line is anything that you inherit, whether it's cash, let's say it's a house, maybe it's your parents' house, even investments, the value of just those in general are not considered taxable. So let's say you inherited a couple $100,000 in a bank account, a house that's worth $1 million, and then maybe a couple $100,000 in a brokerage account. You add all those up, that's not going to be a taxable situation to you. So kind of sounds weird, but all that cash and all that money, and let's say you get this house, you're not going to be paying any income taxes on that. So that's a good thing. The caveat to that is anything that you receive that generates income, that's going to be taxable. So the cash, not necessarily, because that's just cash. That's not generating income. The house, that's just a house that was your parents, and now you're going to live in it, or just have it as a second place. That's not going to be taxable. Brokerage account's a different story, because that most likely is going to be generating interest, dividends. If you sell anything, then there's capital gains involved. So again, whatever income is derived from all of these assets, it's the income that's going to be continually taxed to you. So with the brokerage account, just think of it like if it was your own brokerage account. So again, the dividends you're going to pay taxes on, the interest you're going to pay taxes on. And again, if you sell any investments, then there's going to be that capital gains tax that you'd have to worry about. And that's just all dependent on what your current tax bracket is. So it's a little bit different for everyone. So that's the biggest takeaway. Nothing that you receive is taxable in and of itself. It's just whatever it produces income-wise. The other thing to think about is, and this isn't necessarily an income tax per se, but you do have that estate tax. And for the majority of people, they don't really have to worry about paying that on behalf of their parents' estate. The estate tax exclusion, I know that Congress just made that permanent, and that goes up each year with inflation, but that for argument's sake, I think that's about 15 million, might be a little bit more, a little bit less. However, some states have an inheritance tax that is much smaller. One that I can think of off the top of my head is the state of Oregon. I believe if you inherit anything that's over $1 million, then you have to pay an estate tax to the state of Oregon. So that's just a little caveat depending on what state you live in, and that's just good to find out while you're going through that whole process, because you might have to file a state tax return and pay any necessary taxes when it comes to that.
And kind of just big picture, as you're going over some of the nuances of the taxes, the whole reason that when you inherit assets such as cash or a brokerage account or a house, the reason that value isn't taxed is because you get that step up basis in those assets. And that's basically, you can think of it like you're inheriting the property at the current market value. That's almost like your purchase price of it.
Yeah.
So that value isn't going to be a taxable event. But from, like Jay said, the income could be a taxable event, or any gain that from the date that you inherited the property, or whether it be a brokerage account, a house, what have you, any gain from that value on the date of death to when you actually make a sale, if there is a gain, then that's a taxable event, and it could be a capital gains tax type of issue. But I think what really trips people up a lot of times is, they inherit a house for $1 million or something, or a brokerage account for a few $1,000,000. That inheritance is not the taxable event because of the step up basis. And it's very important that you document, those values, or get the cost basis stepped up on a brokerage account, because it just makes your life a heck of a lot easier when you do go and make a sale, to document that, basically what your purchase price or what your inheritance, value was, to really limit the taxes.
Yeah.
Any potential taxes.
Another thing I forgot to mention is, if you inherit any qualified retirement account, so think IRAs or 401ks, again, you don't pay taxes on that whole value that you inherit, but whatever you take out of that, then that's going to be considered taxable income, just like if it was your own 401k or your own IRA. And we'll go a little bit deeper into, like, what are you supposed to withdraw? What's the definition of a qualified beneficiary versus non-qualified? We'll go over that in just a little bit. But yeah, those accounts as well, you're only paying taxes on whatever you take out of each year.
Yeah, they definitely don't make it easy, right, Jay? Because you have normal accounts like brokerage accounts and homes and things that are not retirement accounts, and they're taxed one way. And then you do have, like you're mentioning, IRAs, Roth IRAs. While they're not taxed, they have their own set of rules. You just retirement accounts, annuities, things like that. They're taxed completely different when you do, inherit those assets.
Yeah.
All right. So I think that goes over the general, tax implications, the different assets and the stepped up basis and things. The next tip really is, more along the lines of just taking your time when you do inherit assets, and don't make any, swift emotional decisions, I guess is probably the best way to say it, because, typically you're inheriting an asset, someone close to you has passed away, right? So that's an emotional event that you're having to deal with, and that can sometimes cloud your judgment, and maybe, you're not in the right frame of mind. So really the second tip is just to take a breather and kind of take your time in making decisions, I guess. is the biggest thing, because yes, you need to do things to inherit the money, and there's boxes and paperwork that need to get checked and completed, so to speak. But before you make any big decisions, it's really, I think, a good idea to maybe let the dust settle, and really put some good thought into, now that you've inherited assets, what are you going to do with those assets, instead of just maybe making the wrong decision, or trying to do things too quickly and not understanding what the implications are with the type of asset that you inherited, and ultimately, if you do it too quickly, you might run into a situation where you did something that you can't be undone, and now you're maybe in a tax situation you didn't want to be in, or you did something that maybe upon further reflecting you wouldn't have done that way. So it's just good to kind of take a breather, let things settle down, get through the emotional aspect of it, and as that grieving kind of starts to dwindle a little bit, it's like you can make better decisions with the inheritance.
Yeah, you don't want to just day one spend it all on every dream thing that you've ever wanted, because then if it's a nice little nest egg that you just inherited, you want to be prudent with that. You don't want to just blow it all completely on just things that are not really meaningful. Or I've encountered situations where clients didn't do this, but they ask me right away if they should go and pay off their own house with this large sum of cash that they got. And in theory that might sound nice, but if that's if you don't really have anything yourself for retirement, let's just say, and you have now this nice little extra nest egg, and your house payment is very, very low, let's say the mortgage rate is at the high twos or low twos, then it might make sense just to keep continuing with that mortgage whilst maybe investing this sum or doing something else that you can allow that money to grow. So yeah, it's good just to stop, take a breather, analyze and assess the situation before making any big type decisions.
Well, and I think it goes back to our first tip. You need to understand the full impact of what you're doing, because to your example, maybe you don't want to pay off your mortgage with a inherited IRA or something
Yeah.
where you're going to pay huge taxes to, pull out a few $100,000, whatever that might be. So you don't want to just do rash things without fully understanding what you're doing, what the implications of it are.
Yeah. Yeah.
All right. So the third topic is more something how to be a little preventative, and it's really how to prevent or avoid probate. Because when you inherit things, sometimes those assets could go through probate, but there's a lot of ways to avoid probate. You want to really avoid probate at all costs. So there's a lot of things you can do or have discussions with your parents or whoever you might be inheriting assets with, or if it's your own assets, you might want to structure things in a way to avoid probate. And there's a lot of easy ways that you can do that.
Mm-hmm.
The first really being, you might want to consider setting up a revocable trust where, you put your non-retirement assets into a trust where you're laying out all of who the beneficiaries are and who's going to handle distributing the assets. You put your home and your brokerage and any large bank accounts and things like that into the trust. That way, when there's an inheritance, those assets quickly and easily get passed along to the beneficiaries and don't have to go through probate. You don't have to spend time and a lot of effort in probate court. I mean, I've had clients spend over a year dealing with probate. Especially if you don't do it all the time, it's not something that's very cut and dry. It's like you're having to learn on the go, and it's not something you're going to want to do, certainly.
Plus it's costly as well.
Yeah, if you hire an attorney to represent you in probate, they're going to charge a percentage of assets to assist you with that. So it can definitely be costly.
Yeah.
And two, if you don't go the trust route, at a minimum, you need to put transfer on death instructions on non-retirement accounts. So a brokerage account, you can put TOD instructions at the custodial level to where at least those beneficiaries can be listed on the account and make a claim directly with the custodian. That will definitely speed up the process and avoid things like probate. And really the last one is to review your beneficiaries often and make updates if needed. But on retirement accounts, make sure that those beneficiaries are listed and who you want to actually inherit the asset. Because if you list somebody on an account that they're going to get 50% of it or whatever it is, and you have a falling out with them, you might want to update that as soon as possible, because if something happens and you pass away, the custodian doesn't care that you got into an argument over Thanksgiving dinner with them. They're going to just distribute it as you've listed it. So review the beneficiary provisions and first and foremost, make sure that you have them listed on the account, because you wouldn't believe the amount of people I come across that they started a 401k at work and they don't even have their spouse or anybody listed on the 401k. So it's very important.
Yeah. And kind of going into those 401k qualified retirement accounts, the next tip would essentially just be understanding how inherited IRAs or inheriting a 401k works. And so it's not just a cut and dry, you inherit it and then it's now yours and you can do whatever you want. There's specific rules. So number one, if it's a spouse that's inheriting an IRA or 401k, they essentially can elect to treat it as their own. So they can roll it over. It would just be going into their name and their name alone. And if they're not 73 yet, then they don't have to take any required distributions. Again, it's treated just as if it was their own IRA or 401k up to that point. And then once they turn 73, then they have their own required distributions. For anyone that's not a spouse, so let's say it's kids that are inheriting an IRA, currently right now, if they inherit an IRA, they have to have that account withdrawn within the entire account has to be withdrawn within 10 years from the date of passing. And they have to take a required amount each year, but at the end of that 10th year, the whole account balance has to be liquidated. So usually an easy way to look at it is you take 10% a year, and then whatever's remaining on that final year, just take that out. But if it's a large IRA, you have to plan for the taxes on that, because again, this is all pre-tax money. And let's say it's $1 million IRA that you're inheriting and take 10% a year, that's $100,000. Well, if you're working and have your own income and wages, this essentially could either put you in another tax bracket, or just you're paying high taxes on this extra $100,000 for federal and for state. So taking that RMD out, you want to make sure that you have the necessary taxes withheld up front, just so you don't have a big balance at the end of the year, and you just avoid any unnecessary penalties when it comes to filing your tax return.
Yeah, and we don't have to get into all the nitty gritty on this particular point, but just know that there are some exceptions to the 10-year distribution rule, depending on your age, as far as how closely in age you were to the decedent. Also, if you have like some medical exemptions, and there's a couple other items. So, if you think you're going to be in a situation like that, look that up. But there are some exemptions where you don't have to have it distributed within the 10th year. And that's a newer rule. And unfortunately, the government kind of caught on to these people who have had inherited IRAs, and basically you take a little bit out each year and you keep it invested, right? And then that thing is just growing tax deferred for basically their entire lives. And so I think the IRS wants some tax money, so they're going to require you to distribute it now and within 10 years. And so that's just the way it is. You just need to plan for the taxes as best you can. And there is a planning opportunity there, Jay. I know you've dealt with many times, as have I. Maybe you have a year in the future where you're going to be retired, or you have a bad year as far as work, just depending on the type of work that you do, so your income's a lot lower. That's where doing some tax planning comes in, where you might want to consider taking more of a distribution out, or delay as much as you can, if depending on your situation, delay distributions until a later year where you can take more out because you retired or what have you. So there's a lot of kind of moving components to think about when you are in the 10-year rule.
Yeah.
So really the last tip is just to seek guidance if you need it, because it's a very complex situation. Like we've discussed, there's different types of assets. They're all taxed differently. You have a lot of rules depending on what you're inheriting. And, especially if you're not familiar, not only with the rules, but if you're not familiar with dealing with a large sum of money, you might be inheriting $1 million+ dollars. So it's like you need to be a good steward of it first and foremost, and you need to seek counsel when it's appropriate. And people like, registered investment advisors or CPAs or estate planners, they can help guide you. I know Jay and I have done that with many clients inheriting assets. They can help guide you on how to make the right decisions, how to follow the rules, and give you things to think about if you're in that situation, because there's a lot to consider, and it's definitely not one size fits all.
Right. Yeah, don't take what you read on the internet as gospel, because every situation is different.
Yeah, well, especially depending on your tax scenario and what your life looks like. But because it could be a great opportunity too, for you to, like I mentioned, be a good steward of the money, but it can really change your life for the better potentially. And you can now do things maybe you never dreamed of doing, but it needs to all be incorporated in what your financial plan is, what your tax plan is, and your estate plan. So those three kind of pillars need to work together. And if you need to seek counsel to do that, it's definitely worth it.
Yeah. Yeah.
Well, we hope that you enjoyed these 5 tips when you're inheriting money. If you did, please like, subscribe, and we look forward to seeing you in the next video. Take care.